there. Welcome to Trading Day. I'm Lindsay Biscaya. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Canada swung to a trade surplus in March. Data from StatsCan shows the country posted a surplus of $1.8 billion, the first since September of last year. That boost was due to surging exports of oil and gold driven by the war in Iran. Overall, exports rose by 8.5%, reaching the highest level since January and fueled by a 24% rise in metal and non-metallic exports. Meanwhile, Canada's trade surplus with the U.S. widened to $7 billion, and non-U.S. exports rose to a record high. Shares of Shopify are seeing a steep drop today. The e-commerce giant posted profit and revenue in its most recent quarter that beat estimates, but investors are focusing on its outlook. Shopify issued a forecast that implies slower revenue growth and rising costs. There also seems to be concerns around artificial intelligence and what the company is doing to combat the risks.
What we're seeing is not really a reaction to the earnings. It's been what we have seen out of a lot of software names where maybe they don't have something definitive to say to combat, the risks around AI. Can someone just go into Claude and create whatever they want that Shopify is currently doing? And, I kind of want to see Shopify address that and have some strong things to say about what their moat is to combat that type of behavior from individual resellers.
Meanwhile, shares of Keyera are coming under pressure today after Canada's Competition Bureau challenged its acquisition of Plains Canadian natural gas assets. The watchdog says the deal would harm competition in the natural gas sector, specifically at Fort Saskatchewan, which is Canada's primary hub. Keyera says the pushback does not prevent the deal's ability to close, adding that it disagrees with the watchdog's findings. The Bureau says a merger would allow increased prices and would further deepen control over critical infrastructure. We'll take a look at the TSX this afternoon. It is trading basically flat at the moment, still above 33,000 points. We'll continue to watch that one for you. A bit of a different story when we look south of the border at U.S. markets today. It looks as though markets are up while the price of oil is down. The Nasdaq up by 0.9% at the moment, so almost a full percentage point. Investors seeing this continued ceasefire between U.S. and Iran as potentially good news seems to be bringing some optimism to the markets today. Toronto home sales rose in April. That's according to the Toronto Regional Real Estate Board. This is the biggest monthly gain in 9 months for the city. So here to discuss this and more is Lori Pinkowski, Senior Portfolio Manager at CG Wealth Management and founder of Pinkowski Wealth Management. It's great to have you join us. Good afternoon.
Yeah, thanks for having me.
Let's start with those home sales numbers that we're seeing, prices in both Vancouver and Toronto. What are your biggest takeaways? Was there anything that was kind of surprising to you that you didn't expect?
Yeah, when we're looking at Canada's two largest markets, we're seeing, as you mentioned, sales are up 7% in Toronto, which is obviously welcome news after we've seen slow sales for some time. When we're looking at home prices, though, they're still off over 20% since the peak back in 2022. And when we're looking at Vancouver's real estate market, we're seeing that home sales have decreased still 2.5%. So it's a bit, it varies between obviously the two major markets in Canada. However, still, as I mentioned, off the peak, we're seeing home prices down 20+% even. And when you look at the stock market since that period, markets are up like 60% in the same time frame. So I was always worried that a lot of Canadians own a lot of real estate. They're real estate heavy, especially here in Vancouver. And so that's when you look back and you go, okay, well, it's always wise to diversify, whether it's real estate and obviously into markets. And so my opinion is this trend is going to continue. You have a lot of built up inventory. It's going to take some time for that to be bought up in order for prices to move higher. So obviously you want a roof over your head. That makes sense. But real estate is an investment, in my opinion, hasn't, and it looks like it hasn't been the best place to be. So good news out of Toronto. Vancouver is still a little sluggish for sure.
Yeah, and I'm not sure what the sentiment is in Vancouver on this front, but new listings dropped more than 9% for Toronto. So is that the same in Vancouver? And what does that tell you about like you were talking about how the markets are kind of reflecting the real estate situation right now. What does that tell you about people's confidence, I guess, moving forward?
Yeah, when we're looking at listings, I mean, we're still way above the 10-year average, even seasonally adjusted. So I think that, like I said, with listings in Toronto, they're seeing a bit of possibly a tighter market going into spring, which is better. But in terms of here, we still have a lot of listings, and like I said, that needs to be bought up in order to see home prices increase. So I don't think there's a turnaround in the real estate market at any point in the near future, especially in the Vancouver market. But it's, like I said, good news in Toronto. We want to see things turn around, but we need lower rates for that, in my opinion. And we haven't seen lower rates. The Bank of Canada is even a little strong on possibly increasing rates. And so we'll have to see where that goes. But I don't think people get excited to go out and start buying a bunch of real estate if we have mortgage rates between 4 and 5% right now. So if rates do come down at some point later this year or even into next year, that would be positive. But like I said, I don't see that writing on the wall at this point, especially with elevated oil prices. So we're obviously watching that news daily and monthly as the data comes out. I report on it quite a bit on the radio here as I have a show. But when we're looking at the actual data right now, it's not great, but getting better in Toronto.
For sure. Okay, so let's move on then. We'll talk a little bit more broadly about markets to start, because it seems as though, markets are rallying back today. Price of oil is down. What you're seeing reflected in the markets also, is that more because of tensions in the Middle East, or is that because of a stronger earnings season? Like, where do you think, or is it both? What do you think is driving this?
Definitely both. Obviously, markets have been somewhat volatile over the last 11 weeks just because of the situation with Iran and the U.S. What we saw yesterday and over the weekend is tensions were rising again. So you saw markets off a little yesterday. But then the U.S. came back today and said basically they don't want to escalate. They want to de-escalate. Iran saying there's progress in some of the talks that they're having. But we're only seeing 4% of the activity in the Strait of Hormuz. So it's every day you're getting new news. And so it's important to obviously closely follow that. But what the markets are telling us is they're looking forward. And markets can even be looking 12 months forward. So what the market is focused on right now, in my opinion, is on earnings. We've had a really good earnings season thus far. And just going back to the Iran situation, you see the price of oil. It can move very quickly, higher or lower. So if there is some sort of resolution, the market is obviously pricing in lower oil prices, which is better for the economy. And we haven't seen these elevated oil prices really trickle into core inflation yet. We saw that in headline, but it hasn't trickled really into the economy yet. So if there is some sort of resolution coming quickly, that's obviously going to be even more beneficial for markets. And we're basically at all-time highs right now. A lot of that has to do with the ceasefire that was announced a few weeks ago, but also earnings season has been fantastic. I mean, we've got 2/3 of the S&P have reported, and 84% have beat expectations. And so I know that we're looking at WTI oil here. And what we've seen is, of course, it is elevated, but it has come away from the peak where it was.
And I do want to... Sorry to interrupt. I do want to ask you about a couple of companies, as you say, like we're seeing many companies beat expectations here. There's a few you wanted to go through, and some I wanted to ask you about. Thomson Reuters also beating estimates in first quarter revenue. Was there any key takeaways from Thomson Reuters that you wanted to mention?
No, I think just with the increased market activity, obviously that's a positive there. When we're seeing various companies reporting, you're looking at, this is not a company we own either, but you can see that earnings expectations going forward, or guidance, if it's weak, it's obviously being hit. We also were talking about PayPal is another one that's off quite a bit today, off 10%, for example. There's a lot of competition in that space, and even though earnings may be looking okay on the surface, when you're looking at guidance, it's not. And PayPal is one that's just been hit hard, and I guess the name for it is PayPal at this point. Again, a company we don't own. As active managers, we recognized a long time ago that this company consistently has earnings issues and is not performing. So that's a company we also don't own, but it's being hit today. And then you have Shopify as well, off. I think it's 14% right now. So yeah, you want to make sure you're in the right companies. at the right time and avoid some of those companies that are having bad earnings reports at this point, because there's so many good companies to choose from, whether you're looking at financials, industrials, materials, consumer discretionary. You just need to be selective in what you're owning. So you don't want to just own the market. You want to be selective in the sectors that you're owning and pick the strongest companies in those sectors.
And speaking of strong companies, Cameco is down almost 3% at the moment, but it had a pretty strong earnings report. It was up this morning. What do you make of what you're seeing coming out of Cameco?
Yeah, Cameco is a stock that we do own. We want exposure to that company, and looking at it, we feel there's a lot of strength going forward, and they're going to have increased revenue growth. When we're looking at kind of AI and the electrification of that, it's important to have other energy plays out there, and so that's why we have exposure to Cameco at this time. And so we've held it for some time, and it's been very profitable for our portfolios for our clients.
Okay, we're going to have to leave it there. We're out of time. Lori Pinkowski, Senior Portfolio Manager at CG Wealth Management and founder of Pinkowski Wealth Management. Great to have you on. Thanks so much for joining us.
Thanks so much.
Thank you. Coming up, GTA home sales are rising, but prices are still falling. So what does that mean for buyers and sellers this spring? More on that coming up with Jason Mercer after the break. Sales are up, listings are down, and prices are still below last year. The GTA housing market is sending some mixed signals this spring. Joining us now is Jason Mercer, Chief Information Officer at Toronto Regional Real Estate Board. It's great, and he joins us in studio as always. Great to have you.
Thanks very much.
I'm not sure if any of these numbers were surprising to you. I mean, there was some estimates that maybe we'd see things pick up in terms of home sales halfway through the year, right?
Yeah, I mean, we've seen an improvement in affordability really over the last year or so, and that's been on the back of two things. First, prices trending lower as buyers have benefited from more choice in the marketplace, and then at the same time, we've seen lower borrowing costs. So if you look at the peak of the interest rate tightening cycle, the required income to buy $1 million home in the GTA was over $200,000. Now that's sort of between, say, $150,000 and $160,000. So that's a pretty marked improvement in affordability. And so we started to see some of those people who were on the sidelines, they had every intention on purchasing a home, moving back into the marketplace. Still below the 10-year average in terms of sales, but picking up nonetheless.
Picking up. And there was people sitting on the sidelines for some time, right, before because there was some uncertainty about what was going to happen with the economy. New listings dropped over 9%. Is that a sign, though, that sellers are kind of holding back at this point still, do you think?
I think certainly when you look at on the listing side of things, if you don't have to sell your home right now, there's been a lot of uncertainty, obviously, on the affordability front. That's improved. There's also the uncertainty now a bit on the pricing front, and it's true. We continue to see prices trend lower on a year-over-year basis, albeit finding some momentum on the season-adjusted monthly change. And I think as we see market conditions tighten up, as we move through the remainder of 2026, that should provide some support for pricing, and then ultimately see things start to trend upwards as we move into 2027. I think that'll be an important signal for home buyers that are still putting that decision to purchase on hold. They want to see that price sort of solidify and have confidence that they're going to see the value of their asset increase over time.
Is that what you're expecting then for the rest of the year? Maybe listings will go up as well?
I think certainly if we start to see tighter market conditions and we see some support for pricing, that'll see both sales and listings potentially increase as more people move off the sidelines back into the market, and then obviously existing homeowners react to that.
In the GTA, though, the average home price is just over $1 million still, which is pretty crazy. Are conditions finally starting to favor buyers? Like that's such a high number, but it is coming down.
Yeah, again, I mean, I think if you look right now relative to an average price that was over 1.2, as we came out of the pandemic, that does represent a pretty substantial improvement in affordability. I mean, obviously, borrowing costs aren't where they were in the second half of 2020, but nonetheless, it's a more affordable monthly payment today than what it was in previous years. And I think that'll be especially important for first-time buyers. I mean, our polling that we did at the end of last year, looking forward into 2026, suggested that we would see an uptick in first-time buying activity. Obviously, they're very interest rate sensitive, and so pointed at segments like the condo market, I think there's a lot of choice for them right now, or you can negotiate a good price.
there's still a lot of pent-up demand sitting on the sidelines. We talked about this near the beginning of the conversation. I remember earlier in the year, a lot of that was because people weren't sure about what was going to happen with the economy.
Yeah.
You've got a lot of things like renegotiations with the U.S. and Mexico coming up. Now there's talk that maybe we could see interest rate hikes rather than cuts. So are people still feeling uncertain, do you think? Like, what's kind of the sentiment out there in terms of those who are still sitting on the sidelines?
Yeah, I think uncertainty still exists, and certainly our trade relationship vis-a-vis the United States is really important, and obviously some of the mitigating factors, policies that could help, offset that will be important as well. People are looking for some guidance on that front, but also thinking about the geopolitical issues and how that impacts oil prices and inflation is important as well. And just to put it in perspective, I mean, even with the uptick in sales, we're still trending on an annual basis more in that sort of 60 to 65,000 range. In a normal year, we'd be expecting to see more in the sort of the 100 to 110,000. So that kind of illustrates the level of pent-up demand, but also sort of points to the fact that as affordability improves, how quickly things could turn around from a sales perspective as well.
And I wonder too, maybe you can't answer this question because it's kind of a weird one, but you say in a normal year, like we're still trending below that 10-year average. Do you expect us to really get back to what we consider normal, or is the housing market kind of forever changed in some ways?
I think so. Like when you look at demographics, and so in terms of population growth, if you strip out the impact of temporary migrants where people have left, and just from a policy perspective, not as many people are replacing them. If you strip that out and just look at permanent migrants, so people moving to the GTA from all around the world, that's still very, very strong, and all those people are going to require a place to live. More of them initially are pointed at the rental market, but what we found is newcomers to Canada tend to purchase homes more quickly. And so ultimately, you'll see, the standing inventory that we have right now absorbed. And I think the issue really moving forward in the medium to long term is that, the pipeline is going to start to dry up in terms of new home completions. And so the concern is that over the long term, if we don't have enough housing stock to meet that continuing growth in population, then we start to see unsustainable price growth again.
Do you think we're on track to meet that demand, or at this point, is it hard to say?
I think right now there's a substantial amount of inventory in the resale market, but as that starts to get absorbed, as that unwinds, if we're not seeing new projects come online to sort of meet future demand, it could be problematic. And I think especially where we need to be looking is those types of housing, that sort of quote unquote missing middle housing, plexes, stacked towns, et cetera, that bridge a gap between traditional single family homes and condominium apartments.
Okay, we'll leave it there. It's so interesting. Appreciate you coming in as always.
Thanks very much.
Thank you. That is Jason Mercer, Chief Information Officer at Toronto Regional Real Estate Board. Up next, shares of the operator of the Toronto Stock Exchange, TMX Group, are trading at prices not seen since last summer after the company saw a sharp rise in first quarter profit, more than double the same period last year due to strong growth across its core business. More on that after the break. We're watching shares of TMX Group today after the Toronto-based financial services company logged a beat on revenue and adjusted earnings. And to tell us more about the results and what's ahead for TMX, we sat down with John McKenzie, CEO of TMX Group.
What we're seeing this year in the first quarter and a continuation from last year is all three core components of TMX. So, the capital raising area where we support companies going public and raising money, the insights area in terms of our data and information suites, and our trading areas are all looking at double-digit growth rates as investors, both in Canada and around the world, really use TMX capabilities to engage in the marketplace. So this is one of those few quarters where every part of the engine's firing.
And so, as you say, you're seeing strong performance across diversified global enterprises. Can you tell us where this segment of your business is seeing strength?
Well, I mean, from a capital raising standpoint, we're actually seeing it across multiple sectors. So we saw, $10 billion raised across the two markets in Canada, TSX Venture. You probably know already we're one of the few markets in the world that actually operate at both a junior ecosystem and a senior ecosystem. That's made it really usable in terms of supporting the, the resource sector, which is, roughly half of that capital raise in the quarter. But we're also seeing capital raising from other sectors. So we've seen IPOs in biotech. We've seen IPOs in technology like Xanadu, in food companies. So you're seeing a lot of different companies come to the market to raise capital, either in new issues or in follow-ons to support the growth of their business. So, the results are really a testament to really strong markets.
And as you say, you're seeing more IPOs. Vancouver-based Lumina Metals went public on the TSX last week. What's your outlook for more IPOs this year And what areas are you seeing strength? You kind of answered that part already in terms of sectors.
Yeah, very positive outlook. We're seeing a lot of conversations with companies that are looking to raise money. Like you said, it's across multiple sectors. And I always like to remind folks, it's actually not even just the IPOs that are the story. Like, that's the ones that get the headlines, they get the splash. But in the first quarter alone, we actually brought 32 companies to market. Some of them were IPOs, but some were through other vehicles as well, like qualified transactions, capital pool companies, uplistings from other marketplaces. I think 11 mining companies in that alone. So again, multiple sectors, resources driving the way, and a lot of different ways to raise money. The one area we haven't seen yet, and it could be a harbinger of things that come in the future, is despite all the energy pricing uncertainty in the world, that's a sector we haven't seen finance and look to advance in terms of investment yet. That could be one that comes later in the year.
And in terms of trends, I think you kind of answered this by saying 11 mining companies. Like, that's probably the biggest trend you're seeing in terms of these companies that you're bringing on.
Certainly the biggest trend, but again, not to oversay what we're seeing in terms of industrials, financials, technology companies. And the technology companies are really important because, for a couple of years, there weren't technology companies raising public money. And then we had a phenomenal IPO with Xanadu just recently, both listing here in NASDAQ and with really good investor follow-on. So that's a good sign. That's a good sign for companies that are getting ready to go to see what kind of application they can get in the market.
Over the past couple of months, though, we have seen Canadian companies being acquired by foreign ones, right? Like recently, UK-based Shell acquiring ARC Resources, Tech Resources, and Anglo American. Are these trends something you're concerned about, seeing some leaving the Canadian market?
I always want to put it in context because the trends we should be really focused on is how do we create great new companies and grow them. And if some of our companies grow to a size and scale that they're viable globally, or people want to bring them into larger organizations, that's fantastic. That says we're building good, viable companies. But we've got to make sure we keep building the pipeline for new companies to kind of grow and take their place and expand and scale over time. That we need to do more of. Now, we've got a great pipeline of private companies we engage in, over 1,500 private companies that could raise public money in the future. But that's why we always advocate for improving competitiveness of the Canadian ecosystem, things like tax reform, regulatory reform, over and over again, because we want to make sure this is still a market that creates great new companies. At the end of the day, I'd like to see more investment in the Canadian companies so that they can scale up and candidly be the acquirer globally. So great when our companies get bought, but also better when our companies are doing the buying and building. Very much like we announced a couple of weeks ago with our acquisition of CBOE Canada, CBOE Australia. This is a chance for us to expand into another geography, build Canada stronger, but also create capabilities for global investors to engage in multiple marketplaces. So we're hopeful that companies use the market to raise capital to build and grow and expand outside of Canada and then bring more of the world to Canada at the same time, like what we're doing.
So you're not concerned then, to kind of answer that question?
No, a healthy ecosystem keeps creating new opportunities as long as we keep creating the conditions for them to grow.
Okay. For companies like GFL, though, for example, that are moving their headquarters to the U.S., how do you try to keep them listed at the same time on the Toronto Stock Exchange?
By creating a great investor experience for them. The Toronto Stock Exchange is very liquid. We've got index inclusion that gives more exposure to investors of those companies. So even if they are dual listed and headquartered in different geographies, there's still a really good investor base here that wants to engage in that company. Now, we never shy away from a company growing globally, putting their headquarters where it makes sense, and listing in multiple marketplaces. We've actually found when a company lists in multiple marketplaces, it actually raises the water for everything, because it actually brings more investors into it. It makes capital raising better. You get arbitrage across border, it creates more liquidity. So having great Canadian companies grow to size and take a global footprint, we should celebrate that and just at the same time keep them listed here as well, keep them in the Canadian indexes, keep the Canadian investors engaged in them.
I was going to ask about that, like listing on multiple markets. You don't feel like you have to compete so long as they're still listed in the Canadian markets?
I'm not saying we don't have to compete. We have to compete every day. We live next door to the most liquid market in the world, and that's why our trading capabilities, our rules, our go-to-market strategies have to be equally competitive, if not better, than they are in the U.S. Because it's such a liquid market next to us. But that being said, we can coexist, and it's kind of the benefit of being right next to the U.S. market is you're forced to be really competitive on service, on value, on price, and the proposition to the market. And that being said, companies we often find, especially those ones that are more in the mid-size, often get a better experience in Canada, both from a capital raising standpoint, from an investor coverage standpoint, from the size of their business in the index inclusion. So it's not all one market or the other. There's benefits to both.
Just quickly before I let you go, what about trying to encourage American companies to list on the TSX? How are you doing that?
We've always been doing that. We actually, I think, are number 3 in the world for international companies that list on our market. We have over 200 international companies. About half of them come from the U.S. market. And where we really focus on that is where we create more advantage. So, that fact that we've got the junior capital ecosystem and the public ecosystem, that doesn't exist in the U.S. market the same way. So we can support junior capital raising from U.S. companies on the venture exchange a way they can't do in their home market. So that's a real benefit that we bring to bear.
That was John McKenzie, CEO of TMX Group. Up next, Propel's credit losses are easing, dividends are rising, and U.S. growth is accelerating. We'll break that down and their latest quarter with the CEO when we come back. Canada's largest housing market is showing some signs of life, with sales rising 6.1%. That's the biggest monthly gain in 9 months. Data from Tribe shows buyers are returning as lower prices help to stabilize the market. Benchmark prices also held steady in April, ending a months-long decline, although they remain below previous levels. And shares of Thomson Reuters are down in today's trading. That's after the company's forecast for second quarter and full year organic growth disappointed investors. Reuters also cut its outstanding shares by 6.5 million in a reverse split. Nonetheless, the company topped revenue and profit estimates in its latest quarter, with revenue surging nearly 10%. And shares of Ballard Power are soaring today. The company reported a smaller loss in its latest quarter, as well as revenue that grew 26% compared to the year before. Sales in Ballard's stationary segment also came in well above what analysts were expecting. And we're, of course, watching the markets closely today. The TSX currently basically flat at the moment. We're waiting to see if more gains happen today for the TSX. It's just about that 33,000 points mark. A different story for U.S. markets, though, today. They seem to be rallying. The Nasdaq up almost a full percentage point after investors seem a little calmed because of the ongoing ceasefire between the U.S. and Iran, but also some strong earnings season results seem to be boosting the markets up. And speaking of that, Propel Holdings shares are surging after the fintech company reported a stronger start to 2026, with loan growth holding up, credit performance stabilizing, and another dividend increase, even as concerns linger over consumer strain and the broader economy. So to walk us through the latest results, we are joined by Clive Kinross, CEO and co-founder of Propel Holdings, and he joins us in studio. Great to have you.
Yeah, delighted to be in your new digs.
You say, yeah, thanks for coming to our new spot.
Absolutely.
You say it's a good day, so you're feeling pretty good about your latest earnings report. Is that right?
Yeah, we are feeling really good about our latest earnings report. Another quarter of record results, record revenue, record C-Lab. Was a fantastic first quarter of the year. So couldn't be happier, actually.
It seems to be stabilizing after some volatility last year. Is this quarter, do you feel like it's a turning point for Propel Holdings?
I think it's a big turning point, and I think it's one that we're not surprised about. You know, we did see an uptick in delinquencies in the third quarter of last year, which bled into the fourth quarter. But as we were moving towards the end of 2025, we really put our foot on the gas, saw very strong demand on the one hand. On the other hand, that was coupled with very stable credit performance. So we leaned into that volume, and that followed all the way through into the first quarter of the year. It was a record quarter from an origination standpoint, about 40% year-on-year growth for new customer originations. And on top of the excellent demand that we were seeing, we saw really stable, solid credit performance. Our provision for loan losses decreased from 56% in Q4 of last year to 45% this year. So a tremendous turnaround. And we expect that the trajectory, if anything, will just accelerate on a go-forward basis.
And you raised the dividend again this quarter. So how closely is that tied to confidence about strong credit performance?
It's the 11th consecutive quarter in a row that we've increased the dividend. We're incredibly optimistic about the growth prospects of the business. If anything, not only did we increase the dividend, as well as grow the receivables balance, which ultimately is what our revenues are a function of. But in addition to that, we paid down several $million of debt, all of which is to say there's more than sufficient liquidity to grow the business, continue to increase the dividend, and fund the tremendous growth of the business.
You're also seeing that the non-prime borrower is proving to be more resilient to the market than expected. So what are you seeing in like your customer base that's allowing borrowers to keep, paying their loans on time?
Yeah, our borrowers are exceptionally resilient, and we truly are living in a K-shaped economy. TransUnion put out a really comprehensive report last week detailing what's going on with the U.S. consumer. And what you could see is demand for loans, unsecured loans, really is at an all-time high at the moment. But the market's bifurcated really between super prime and subprime. The areas of the market where you're seeing declining acceptances are on your prime and near prime market, and that volume is moving into our segment of the market. And as a consequence of that, not only is there much stronger demand as a result of that dynamic, but the quality of that demand typically is higher than what we would otherwise see. So our first payment default rates, which is the default rates on new customers, is really stellar. And with our existing customer base, what they're doing is they appear to be spending less. So we're seeing credit utilization down in terms of lines of credit. We're also seeing paybacks from these consumers higher than what would typically be the case. And all of that is really, really strong from a credit standpoint. So strong growth, strong credit, really driving record results for the business.
Interesting. Can you explain what lending as a service is and what that actually does for your business to start?
Yeah, absolutely. So for the most part, the loans that we originate, we keep them on our balance sheet, and the lion's share of our revenues and profits to date have been from taking on the credit risk. There's a host of different products that we've launched into the market. Recently, we partnered with Column Bank as an example, the first fintech company providing access to credit to underserved consumers, to partner with a nationally chartered bank. And that, for example, is lending as a service, whereby we do the servicing of the loans, the bank originates the loans, and a third party purchases the economic interest in that loan. In so doing, we don't take the credit risk, we don't take the balance sheet, and the ROE on those loans is obviously infinite by definition. That's a business that grew by in excess of 100% from the same quarter last year. And similar to the rest of our business, we expect that to accelerate over the course of 2026.
I was going to ask, is that side of it going to become more popular, do you think? Is it growing in popularity?
It's something, historically, we had huge demand from a consumer perspective for those loans, but we didn't have the capital to support that. That's taken us a while to bring on the capital. We raised $210 million to support the Column program from two of the US's leading financial institutions who are going to pick up that demand, and that will support that program for the next 2 to 3 years. And on the Credit Fresh side, where we also do the forward flow lending as a service, we're fully subscribed over there too. So from a capital standpoint, there's more than enough capital to fund the growth of that business. And we're adding in new states all the time to further the growth of that initiative. I've already mentioned in this K-shaped economy, we're seeing record demand right across the board, also fueling the growth. The other thing we did in the last quarter is really put our foot on the gas in terms of forging new marketing partnerships. So we've onboarded 8 discrete new marketing channels over the last quarter, all of which is fueling the growth for the business in general, but more specifically for the forward flow programs.
It's so interesting because there's a lot of Canadian fintechs with U.S. ambitions, right? But not a lot of them actually are able to make that jump. Do you know what did Propel get right that others have kind of struggled with?
Yeah, it's a great question. And just to be clear, we're in the US, we're in Canada, and we're in the UK.
Right.
In terms of our Canadian presence, Canada represents about 2% of our business. I think that's something that investors sometimes misunderstand about our business because we're formed in Canada, because we trade on the Toronto Stock Exchange. It doesn't mean Canada is a big chunk of our business. And I make that distinction just because we're sometimes confused with other lenders, brick and mortar lenders in Canada, who've had a challenging time in this market. Again, from our perspective, not only does Canada only represent 2% of our business, but in addition to that, we're a purely online business, and we originate our loans using our proprietary AI technology versus a brick and mortar business. We only do unsecured loans. We don't do buy now, pay later, or lease to own, or any of that kind of stuff. In addition to that, myself and my co-founders have led this business for 15 years as distinct from a leadership team that maybe is going through more frequent changes. So all of that stuff makes us completely different, say, to some of our competition in the Canadian landscape. And from my perspective, this is the second business that I've built from the ground up. The first was in the automotive industry, where I built an industry leader that today trades in the New York Stock Exchange. This is the second one. Both of them were founded out of Canada, and both of them had an initial focus on the US market, just because it's a much bigger market from that perspective.
Okay, that's all the time we have, so we will have to leave it there, but appreciate you coming in. Thanks for joining us.
Thank you so much, Lindsay.
That is Clive Kinross, CEO and co-founder of Propel Holdings. Coming up, Palantir has posted record revenue and has lifted its outlook, but the shares are sliding today, down more than 7% at the moment. We'll break down why when we come back. Stay with us. Palantir posted a blowout quarter, beating expectations and raising full-year guidance as demand for its AI platform continues to surge. But the stock is trading lower today after a miss in U.S. commercial sales. So for more on why that is, we're now joined by Dan Ives, Global Head of Tech Research at Wedbush Securities. It's great to have you join us. Thanks so much.
Great to be here.
What is it exactly that you think investors are reacting to today? Because we're seeing Palantir beat on revenue, but the stock is down.
Yeah, there was about 20 million of commercial business that ultimately got put into government based on the way it was classified. And look, even though the headlines will say miss commercial, when you look overall, I mean, they essentially beat, call it $70, $80 million. And as you look into next year, they're guiding much higher into next year, next quarter. I believe this is just a blip. Anytime this stock sells off, it should get bought, given my view of where they play in the AI revolution.
Where do they play in the AI revolution? Because as a software company, that's a big question right now for so many software companies.
Yeah, look, it's a great point. I think a lot of software companies are obviously going through a bit of a crisis in terms of how they're going to monetize on AI. To some extent, they're following what Palantir is doing, because there's no question when it comes to monetization, Palantir, they have a technology and a moat that I really do not believe anyone else can replicate. And I think you're seeing it, a commercial business that essentially went from 10, 20 million a quarter to 600 million in the course of a few years. And that, for every software company, is going to be the quagmire. Palantir has figured it out. It's other software companies that are trying to go down that same path.
Interesting. Palantir does lean hard, though, into defense, national security, AI-enabled warfare. Given today's kind of geopolitical climate, does that make Palantir more vulnerable or more controversial for a lot of investors, do you think?
I think a few years ago, maybe that would have been right. Today, I think investors they shrug that off, because the reality is, especially when it comes to U.S. government, that's the golden goose. That's a bigger piece of the pie. That's where it's not just Palantir, from OpenAI to Microsoft to every tech company that's going after it. And I think it's part of playing in this area, because AI is going to become more and more pervasive on defense, on government, as well as in commercial. And they're not going to not go after what's probably, called a $500 billion opportunity.
As AI tools become cheaper and easier to build, how do you kind of defend Palantir's moat against newer competitors who are maybe offering cheaper alternatives?
Yeah, and I think that really hits on what's been this black cloud over software. In other words, like, why can't this just get replicated? I think, look, they have a technology and moat that I really view as it can't be replicated. And I think that's how they're getting deal sizes, 30, 40, 50 million at one piece. Now, look, are there going to be some software companies that's intermediated? Yeah. But when it comes to the complexity of what Palantir is doing and why governments and why enterprises are going toward them, I don't view it as, this is really not something that I worry about. I think it is massively defendable. And we're seeing that quarter after quarter play out.
Even with bigger competitors like OpenAI and Anthropic, who are building kind of adjacent tools, you still feel as though Palantir is doing kind of their own thing?
Yeah, because I ultimately believe, like, those technologies, as great as they are, the LLMs, essentially, they'll become commoditized over time. Now, it's why Anthropic, OpenAI are so aggressively going after the enterprise. But when you look at what Palantir's done in terms of its oncology, its AIP, if you talk to any customer that's tested the technology, that's gone through it, it is that rare that I truly believe it cannot be replicated. And I think that is ultimately what's going to separate the winners from the losers in software. Who are the ones going to be able to monetize? And also, who are the ones that are going to have the gates up where they're defendable?
Interesting. Okay, we'll have to leave it there. Dan Ives, Global Head of Tech Research at Wedbush Securities. Appreciate your time. Thank you.
Thank you.
Shares of Micron Technology, meanwhile, are soaring today, and we'll tell you why right after this. Stay with us. Shares of Micron Technology are climbing today, jumping more than 11% to hit an all-time intraday record. Micron produces memory chips used in everything from smartphones to AI servers. So let's find out what's driving the stock today. Joining me now is Matt Bryson, Managing Director, Semiconductor and Hardware Research at Wedbush. It's great to have you join us. Thanks so much.
Thank you so much for having me today.
So seeing this record high today from Micron, what is driving that, do you think?
I think it's a number of things. I think, though, most specifically, it's all of the positive news we're getting around AI and data center spend. Right? You had the Global Foundries this morning, for instance, telling us that their data center numbers are going to be better than they expected this year. You had Palantir last night that Dan was just talking about, reporting a whole lot of AI strength, even if commercial was a bit light. And when you think about AI, you need HBM, high bandwidth memory to support that. Now it looks like you need more standard compute servers to support that. We've got AMD talking about that tonight, and would expect them to echo what Intel had to say, which is just standard server demand is better than expected, and you have to hang a whole lot of memory off those servers to make them work.
Is there room for all of that competition, though? Obviously, we're going to talk about AMD in a moment, but just in terms of all these companies who are looking to get into this space?
I mean, from the memory side, that's exactly the problem, is that there isn't enough product, right? So you really have 3 DRAM players. You've got 5 to 6 NAND players, depending upon whether you count the Chinese. And they just don't have enough capacity, in part because they didn't plan for it. And so they just can't meet all of this demand on the AI side, or that's AI related, just because it takes 2 years to build out these facilities to get more capacity online.
You have an outperform rating and a $550 price target on Micron. Does this latest move kind of put pressure on you to go back and revisit that at some point?
I'm certainly. I have to rethink about where my price target is. But what we've had over the last 2 weeks is you've had Samsung tell you that their pricing was up 80-90% for memory. You had SanDisk tell you their NAND pricing was up 130%. You had Hynix, I want to say it was 70-80% price gains. All of those are well above what Micron guided to back in March. And so I think for everyone, they have to take those data points and put them into their Micron models and recalculate where they think earnings are. But the reality is, given those higher price points, you end up with higher earnings power for Micron.
We have very little time left, so just in our last minute, AMD reporting tonight. What are you watching for?
I'm watching for them talking about what they think their AI data center revenues are going to look like in the out years. I'm watching for what they're going to tell us near term around compute. Are they able to get ASPs up? Do gross margins go higher into Q2?
Okay, so we'll have to leave it there. Matt Bryson, Managing Director of Semiconductor and Hardware Research at Wedbush. Appreciate your time and your insight. Thanks for joining us.
Thank you.
And join us Wednesday at 3 p.m. Eastern for Know Your Options with Chris Tom of Moat Financial. You can send in your options trading questions now to knowyouroptions@bnnbloomberg.ca. That wraps up this edition of Trading Day. Thanks so much for watching.